Thank you for watching Morning Markets. I'm Amber Kanwar. We are coming towards the end of Canadian bank earnings season. RBC, the latest to report quarterly results that is failing to impress investors despite beating expectations. Now, it did so on the back of strong trading, strong capital markets activity, which has been kind of a consistent theme throughout the bank earnings season. As we saw, the stock not getting a lot of credit for that. The stock is under pressure right now. Let's bring in Chris Kerlow, Senior Portfolio Manager and Investment Advisor at Canaccord, joining us. Thanks so much for being with us. So we're trying to piece together some themes. Trading is strong, but, seasonally, this is a time for strong trading and expenses. This seems to be a stubborn line for a lot of these banks, and RBC was no exception. Yeah,
we saw the same thing out of CIBC to start the earnings season, BNS. RBC today, this trading revenue was fairly well telegraphed from the large counterparts in the United States. We saw 33% growth in trading revenue there. So I think that was largely priced in, and we're seeing it beat. National's kind of getting some credit for it. It has the largest exposure to capital markets, and why you're probably seeing a positive move here today. But looking at both RBC, even TD, we were fairly impressed by the earnings. We're not sell-side analysts. We don't need to have a target price that everyone's watching every single day. And these loan loss provisions are really adding up. And from an accounting change in 2018, that directly comes off that bottom line. And so if we don't get a deep recession that these are starting to price in, I think it presents a longer-term bullish case for the banks.
That's interesting because some have said that the provisions for credit losses are still too low relative to what they need to be. Yes, they have been ticking up, but, to use your point about if we get a recession, they'll need to move higher. It sounds like you're kind of looking at it from a different perspective.
Yeah, everyone's entitled to their own opinion. I think that these loan loss provisions are pricing a pretty deep recession. It's still below what you saw in 2020. But then we obviously saw this start again, stop again economics, where the Fed and the Bank of Canada stepped in and bailed everything out. So we never realized those losses. And opposed to pre-2018, when those losses would only be realized as they happened, we're kind of front running it. And so if it doesn't come to fruition, it actually will be released again into net income and could be future earnings growth for these banks.
Net income is interesting, especially when you look at net interest margins, which is the difference between what they pay on deposits and what they make in loans. Some have said, again, who are bearish on the sector, that they've kind of come to the end of the benefits of that. Rates are probably only going to move up a little bit more. And it hasn't been a clean story, right, this earnings season, in terms of, yes, they are really capturing them. Some are not capturing it at all. Some are not capturing it to the extent that the street would like. How are you thinking about that story?
One of our LWC Canadian dividend holdings is TD Bank. We think that their net interest margin expansion, because of their exposure to the United States, probably has some more room to run there. You're seeing Fed fund futures actually taking cuts kind of off the table for this year and moving higher as we've seen stickiness in inflation, strong wage data. So there's, in our opinion, a little bit more room to run on that NIM margin. And a lot of people, I think, are also over expecting softness in the housing market. And that really hasn't come to too much fruition. I think RBC, who's guiding at about 5% above the street on mortgage lending this year, could be a little bit of risk there because we may not see that type of mortgage formation with where rates are today.
Since you brought up TD hasn't even reported yet this week, and we've already got so much news from them. They had a big settlement earlier this week, and now this FHN deal being called into question. Though I'm seeing some analysts say the stock is down, of course not as much as FHN. This could be ultimately positive for TD. National saying that, Barclays saying that. What's your assessment? Why might it be positive?
Yeah, maybe they're not trying as hard to get this deal done than they would have a couple weeks ago before this $1.2, $1.3 billion settlement. They do have strong earnings cash flow. OSFI's raised the bar for Tier 1 ratios to about 12.5%. They're probably the best position for that right now. So we don't really see any issues or limitations there, and still really like the story, particularly for that U.S. business. It's been floated that maybe they have to sell a position in Schwab Group. We don't really think that that's in the cards because of the strong earnings power that they have behind them.
So is that your high conviction idea in the Canadian banks right now?
To be honest, we're liking BNS more. Trading down here in the mid 60s. This could be an $80 stock by the end of the year. We're getting paid over 6% to hold it. And a great strategy long-term with Canadian banks is buy it when you have relatively cheap valuations and sell it near the top. And that's why we probably don't own a name like Royal, which is, flat on a year-over-year basis.
So it's interesting because Scotia was just downgraded on the back of earnings, actually at Canaccord, but I guess this highlights the difference between the buy side and the sell side. And part of it had to do with, maybe the story is getting a little bit muddied and we're waiting for clarity. The new CEO, really sounded, injected some reinvigoration and was quite candid about the disappointing share price. Do you think that's a catalyst that the new CEO has more permission to be bolder than perhaps an incumbent?
Yeah, Brian Porter I worked under him in the global asset management division eons ago and wasn't the easiest person to work with. So I like the change here. And we have, new management, refresh the stock. You tend to see kind of a bit of a wash in that first quarter as a CEO because you can kind of blame the past on who was before you. So, and like I said, it's a relative valuation situation. We're a low turnover strategy, and we like this name longer term.